Hi, and welcome to the long-awaited class on Tax Cut and Jobs Act of 2017, Trump's tax law. I think I'm going to have to break this up into a couple different sessions because, and I'll email them to you. I think this recorder only does 15 minutes at a time. Anyway, one of the reasons this has been so long in coming is that there's still a lot of things that are unclear in Trump's tax law. The regs, there's the qualified opportunity zones funds. The regs only came out for those a couple within the last 2 months. I was at a seminar in New York Wednesday. A good friend of mine, Mike Hurwitz of Marks Paneth, was one of the people on the panel. The seminar went from 9 o'clock to 2:30, and they were discussing the qualified opportunity funds in zones, and there's still a lot of unanswered questions on them. The regs for 199A, the 20% deduction for qualified business income, came out over the summer, and there's still a lot of things that are unclear about them. I was at a seminar at NYU. NYU puts on a week-long seminar. I think it begins maybe Sunday. I've never gone to the Sunday session, Sunday through Friday, on federal tax law. And the session that I attended, one of the people on the panel was the attorney who was in charge of writing the regs for 199A, and there were people with questions, and he did not have answers. He said, "We just don't know what we're going to do with those questions. With those parts of the law. So those things are not clear yet." And then I was at a seminar, an all-day seminar, tax seminar, tax law update seminar within the past 2 months, and the handout may have been 3/4 of an inch thick. I don't think she got through all of 199A. Okay, maybe she got through 1/3 of the handout. That's how much there is to it, and how many things we just don't know, how many questions there still are on it. So the first thing I'm going to talk about is the new section 199A, 20% qualified income deduction. Okay, if you're in real estate, you should be pretty excited about this because you can reduce that income by 20%. So if you're netting $100,000, 20% of that is $20,000. If you're in a 25% tax bracket, that's $5,000 you're wasting, $5,000 of tax you could be saving under Trump's tax law. Now, you may not like Donald Trump. There's a lot of stuff I don't like. I don't like the way he does a lot of stuff. I know he gets knocked endlessly in the press. Not that I'm a big fan, but hopefully the economy, the market's tanking. But the economy is supposed to be doing well. Unemployment's low, job growth is strong. I know he gets in fights with everybody. I don't know, I probably mentioned this before. When he owned the GM building in New York, I did the tax work, and I never dealt with him directly, but he owned it with his partners, Conseco, I think it was, insurance company out of Indiana or Ohio, and I did deal with them, and in dealing with them, there was no love lost between the two. And there is a book on the GM building. I forget what it's called, but you can find it on Amazon. If you go to Amazon and just search for GM building, you'll probably find it. But a couple of things, he's feuding with China. He wants to throw up all the rip up all the trade deals, NAFTA, everything else. China exposed to tariffs. One of the things I read just this week is that GoPro, if you know the GoPro cameras, they're pretty awesome little cameras. They're made in China, and GoPro is going to move those jobs out of China to somewhere else. And maybe China will give them discounts and things like that to keep them there. But I would think other manufacturers who have things manufactured in China would go somewhere else. And, there's certainly plenty of other places. All Southeast Asia, I'm seeing more and more stuff from like Vietnam. And I would think more and more places. India has inexpensive labor. So it's not as if China is the only place where you can get things done. So anyway, maybe things will work out with that. I really don't like the way he does a lot of things, but I do like that North Korea is not detonating any nuclear bombs. I like that North Korea is not firing missiles over Japan. Japan, whatever their constitution was amended to say after World War II, their their history is of we're like people, and uh, so I'm glad they're not antagonizing Japan, and they're not threatening our West Coast anymore. So those things I like about it. Although a lot of things I don't like about the way he does. So you could be spending. This could save you $5,000 in there. Okay, so let's get on to this thing. The purpose of 199A deduction. Okay, four purposes of it. There are two types of income: good income and bad income. Those are my phrases. They're not the law phrases. We'll get into what the law says. Good income is realtor income. Okay. If you're a realtor, if you're a real estate investor, that is good income. Bad income is accounting income, me, doctors, lawyers, bad income. Rental real estate, well, if you have one rental, I have here probably not. But lately I've been reading that, well, maybe if you have a two-family house, you rent out half of it, so you're doing all the repairs. You know, the toilet needs replacing, the roof needs work. You may not even have to do the work. You hire the roofer, but some of the minor repairs around it, you contract to have the grass cut. If you have one rental property, maybe it does apply to you. So that's one of the things. It's really not that clear. What if you're, say, a limited partner? Okay, in an LLC. Now, LLCs don't have a limited partner, but you have the same function as a limited partner with a limited partnership. To me, you would not qualify for this because that's not a business to you. You're just an investor. But other people thinks that it does. What if you have a rental property and all you do is rental? Well, maybe you are. Maybe it does apply to you. So there's a lot of things that aren't clear. One of the things that I hear different people talk about is that in gray areas such as this, that when eventually people tend to be aggressive. Okay, the accountants are going to be aggressive, the lawyers are going to be aggressive, because it's a gray area, things aren't clear, and the IRS can get wind of stuff. They don't like things. They come out and make regs, revenue rulings, rev procedures where are only they're forward looking. Okay, they may not be backward looking. That's not to say they won't be backward looking, but they may not be backward looking. They may be forward looking. So you decide how aggressive you want to be about pushing the envelope. Now, bad income in the law is known as specified trade or business income. Specified, and I'm not going to read this whole thing for you. You guys can, stop it and read it. But specified trade or business income means any trade or business involved in the services. It's where the individual is providing the services. It includes the fields of health, law, accounting, performing arts, consulting. Real estate brokers are not included. Even though they're real estate brokers in the regs, they come out and say real estate brokers are not included. But please, if you are in a trade or business, check out the latest things that you can find on it. You can't believe everything that you read on the internet. I think the first person to say that I read was Abraham Lincoln. I read that on the internet, that Abraham Lincoln was the first person to say you can't believe everything you read on the internet. But if you go to a reputable site, say, one of the big four accounting firms, one of the other large accounting firms, some of the better law firms, and you are sure that what they're writing is not a pirated page, then what you're reading is, you can be pretty comfortable it's accurate. I wouldn't rely on stuff in like Forbes magazine. I don't know if you guys may know Dave Ramsey. I have him on sometimes. I find him interesting in ways. But whenever he talks about tax, he's absolutely wrong. I don't know if he's ever gotten anything in tax right. So financial writers, they're not tax people. I would not have a lot of confidence in what they write. Things written by reputable CPA firms, written by reputable law firms, yes. But then if you're reading them, okay, and I mention this because a lot of the stuff we don't know, we don't have answers to. So look to find answers if you can. And I look to a lot of different sources. When I first started reading this stuff on 199A, I could not understand it. And maybe it's just the way I learn. I learn my way. Everybody learns their own way. I could not understand it. And I found somebody's article that I could understand it. Written. It was something published by some CPA firm, and it was methodical, step by step. That's why I have to do things step by step, and I could understand it. And so read different things. Don't just take one and say, okay, this way. Read different things, okay, if you really want to deal with this, because believe me, it's very complicated. It's very in-depth. Now, I'm at 10 minutes, so I'm going to have to break this thing pretty soon, I think, but I'll get this first one up. Now, to qualify for the QBI deduction, you must have business income. It cannot be only wages. If you just have a W-2, you cannot do it. You must have income from a sole proprietorship, a partnership, or an S corporation. If you are single, and your income is not more than $157,500, married filing jointly, $315, then your qualified business income deduction is 25% of your qualified business income for good income and bad income, okay? Regardless of whether it's good income or bad income, if your taxable income is below those limits, you will get the deduction. Please feel free at any time to stop these slides, read it over again. Example, you own a sole proprietorship, file a single taxpayer with $135,000 of taxable income, QBI of 120. Your 20% deduction will be $24,000. That's 120 times 20%. If you're in the 25% tax bracket, your tax savings will be $24,000 times 25%, $6,000 that this thing could save you. If your income is above 207,500 single, 415 married filing jointly, it gets more complicated. Bad income, those bad accountants, doctors, lawyers, and you know what? I guess it's just Trump didn't like those guys. He doesn't like the accountants. Maybe he feels we charge him too much. The lawyers, you know, what is it? Michael Cohen is going to jail, and Michael Cohen's saying that Donald Trump was behind the hush money. So I guess maybe it doesn't like it. Doctors, I don't know why he wouldn't like doctors, but you know, they don't get above those limits. We don't get any qualified business income. Between them, between the 157.5, 207.5, 315, 415, you have phase outs, okay? And it gets complicated and ugly. So let me just go. Okay, if you're a realtor, good income, and it's 207.5, 415, and I'm not going to read this. You can please stop it because you won't remember what I say. Your qualified business income is the lesser of 20% of your qualified business income or the greater of blah, blah, blah. Please feel free to stop this and read this thing 10 times. So, example 2. You have a single taxpayer good income. QBI is 260, taxable income 300. Qualified assets are 0, wages are 0. Your QBI is 0 because you have no wages. Now, here is the calculation. So please stop this and walk through it, okay? I'm going to do... The reason I don't want to go through this one is because it's kind of mumbo-jumbo, and you probably would get more out of it stopping it and going through the calculation, writing down the calculation on a piece of paper. But if you don't have wages and you're above that, even with a good income, you lose it. Now, I have an eye doctor, which is bad income. He's between the two, and he never listens to me. And if I was to call him up and explain it, he would not remember. So I put a video of this up on YouTube. It's on GetRicherQuicker.net, my page. And I said, Bruce, please watch this. It could be of value to you. I have a realtor. I did the same thing. I don't think either of them looked at it. So when they lose a deduction, not my fault. I did what I could. So please stop this thing, work through the calculation. But as you'll see here, going back to this, even if you have income, it gets ugly when your income is over these, between them or over them. Without wages, you lose it. Okay, example 3, single taxpayer, good income, qualified business income 260, taxable income 300, wages of 100,000, your qualified business income deduction is 50,000. So as you can see, if you're between those things, or no, I guess this one is above it. I'm sorry, because he's single. No, I'm at 1430, so this thing may end. I'm not sure. If not, I'll go on. If yes, I'll pick up. So single taxpayer over those limits. Without wages, even with good income, he loses it. With bad income, you have to have wages. His qualified business income deduction, 50,000. Let me put the calc there. I'm going to let this thing run to 15 minutes to see if it shuts off, but you have the calc, okay? We're getting closer. It's like the countdown to New Year's. 58, 59.